Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. DealQuest community, welcome to this week's solocast. And listen, I'm going to talk about a topic that I feel like I need, bears repeating every time that there's a significant challenge in the economy, whether that was COVID, whether it was looking back at the global financial crisis, whether it's as I record this today, early May of 2025, the uncertainty around tariffs, around the fear that interest rates and inflation may go back up, the concerns about the volatility in the stock market. Every time there's something that has people be worried about the economy, there is a concern not only on the impact on general entrepreneurial measures, but also on deals. And a lot of times there's assumptions that are not true. And there is panic and there is pulling back and things like that. So I want to talk about it again at this point, what we're seeing at this time, and then just, more general concepts about the way you should approach or think about deals in challenging or uncertain times. So number one, this is, very fundamental, but it bears saying that the biggest frustration for entrepreneurs and deal makers is actually the uncertainty, right? In the order of preference, we want whatever policy, whether it's governmental policies that are affecting things or decisions or whatever it is, we want, our number one choice is that we have it go the way we want it, right? If we think the Fed should cut interest rates, we want to see the interest rates cut. If we think the Fed shouldn't, we don't want to see it cut, right? If we think tariffs are good, we want to see them come into play. If we think tariffs are bad, we don't want them to come into play, or we want them to come into play only at certain levels, whatever it is, right? And then the second best choice is actually that there's a clear decision made that is actually not what we want. And right, that might seem counterintuitive, but the only reason that's the second decision is because the third option is uncertainty. It's consistent uncertainty. And the problem with uncertainty is that it freezes people, right? It has us not be able to make business decisions. You see, if something comes into play, like if you're not in favor of tariffs and tariffs come into play, yeah, that's not as good as, in your mind, tariffs not coming into play. Or if you think the Fed should have cut interest rates and they didn't, that's not as good in your mind as if they cut interest rates. But at least you know what the playing field is. And the thing about entrepreneurs and deal makers is that we're always up against the odds, right? It's why, it's the old joke that I say to, my friends and entrepreneurial buddies, my wife who's an entrepreneur, and to myself sometimes, that if it were easy, everybody would do it, right? So you expect, the ups and downs, the roller coaster of being an entrepreneur, the challenges that you have that directly affect your business. There's going to be economic shifts and that kind of stuff. But the great thing about entrepreneurs and deal makers is that they're resilient. And if the rules of the game change, and that could be regulatory, that could be just the economy shifts, deal valuations change, deal structures change, certain markets become less desirable, others maybe become more desirable. If we can read the playing field and we know what it is, then we can react and we can change our process. Maybe we're focusing in this sector and that has become less desirable, so we focus in a different sector, right? Maybe we can't raise capital, in the equity markets, but we can get debt. Maybe debt financing has become too expensive, so we're going to go to our friends and family around to raise, right? In other words, the playing field, the options, you can move. They may not be as good of options as you'd ideally like, but at least you can react to what is because you know what it is. The uncertainty is the biggest challenge. And this is, unrelated to your politics, right? I think any deal maker, any entrepreneur will tell you, without getting into an argument on what policy is better or worse, or who's causing it, who's wrong, who's right. that the worst thing you can have is uncertainty because you don't know how to move forward. You don't know how to make those business decisions. So we are definitely in a period now, and maybe hopefully by the time this episode airs, there will be less uncertainty. But right now, when I'm recording there is uncertainty. And frankly, there'll be another time of uncertainty in the economy due to, at some point in the future, whether that's due to politics, policy changes, technology changes, international monetary business, you name it, right? Pandemics, God forbid, there's another one, hopefully not. There's many, many factors that are out of our control or that can affect things. And there's always going to be some periods of uncertainty. So what do? Right? If you can't cause certainty, it's actually appropriate to take a step back and evaluate, right? Because if you don't know which direction things are going, the problem is there's a difference between taking a step back and evaluating, potentially looking at different deal structures that can protect you. For example, let's say if the market goes down or if people lose clients, like there are ways that you can structure deals. Maybe you adjust valuations a little bit, but even without adjusting valuations, you can adjust deal terms. You could have more of the money be contingent on the back end. You could require retention of clients. There's a lot of things you can do that will have you continue to move forward where the deal structure will account for the uncertainty in a fair way, meaning that if things go well, let's say the seller will benefit from more purchase price, maybe there's earnouts, maybe there's retention requirements. And if it doesn't go well, then the buyer doesn't pay for something they don't get, right? So there's a lot of ways you can do that. And the reason I raise that is that if you go into total freeze mode, and that's less from a logical point of view, but more from an emotional point of view, a lot of times, all right, people get afraid. We don't know what's going on. So they don't do a full analysis and then say, okay, we're going to slow down a little bit, or we're going to pause this, which might be appropriate, but they just freeze, right? And they wait. And there are other people out there that are not freezing and waiting, and they're taking advantage of opportunities there. So my encouragement to folks in these uncertain times is to, yes, be aware of the uncertainty, investigate it, evaluate it in light of what you're looking to do and whether that, objectively affects things in terms of your doing a deal or in terms of your timing on a deal or in terms of your restructuring a deal. But don't go into freeze mode, right? That is the absolute worst thing you can do. And then here's the other thing that I would encourage you for or caution you against, depending upon which angle you're looking at it. And that is when you hear, whether that's in media, whether that's, from analysts, whether that's from people in a particular industry, that the impact of this particular problem in the economy is going to be X, right? Oh, wait a second, the stock market's going down, there's creating uncertainty. That's going to impact deals and businesses in this way. Inflation's going up, that's going to, affect businesses in this way, right? Interest rates are going up, we're not dropping. It's going to keep in mind that there is no blanket impact on business in general or on deals across the board of any given economic factor, no matter how good or bad it is. Different sectors react differently. Different industries react differently. I mean, the pandemic is a phenomenal example of this, right? I mean, the pandemic is horrible from a human point of view. That's easy to say. And it adversely affected a number of businesses, many sectors terribly, whether that was anybody in retail or restaurant or any of that kind of stuff that really got hurt because people weren't going out and shopping or eating or, going to movie theaters or whatever it was, right? But there are businesses that thrived during it. And some of them are, you could look at particular companies like Zoom, for example, okay, or the food delivery services, right? The Uber Eats and the Grubhubs and the Seamlesses and that kind of stuff. And you can understand actually how they directly benefited from the changes that the pandemic, for example, caused, because they provided services that people needed more of than they did prior. And many of those, Zoom's a great example. It's changed the entire culture and got people doing much more virtual meetings, and you got Teams and you got other solutions. But, Zoom's an example of that, really, really benefited from that economic and all kinds of uncertainty during the pandemic. But then there are other, sectors that aren't as directly affected, right? Where it wasn't because of the triggering event that they did better. Like, most of we do a lot in wealth management. And wealth management, other than a little glitch in, 1 month when the market dipped and came back, I was just talking about this with some of the reporters in the space. M&A continued strong through the pandemic, very strong. And firms did well. Their revenues went up, the deal market went up, valuations stayed strong. And the higher, and even not only was it a pandemic, but you had a very high interest rate environment, which you would think we would be a damper on funding for deals. And it was, by the way, but it's a great example because it was in many industries. The M&A market, through COVID and since, has been slower in a lot of industries. And certainly in recent years, you have a lot of down numbers on stuff. People were hopeful that in 2025, it would come back up. And in many industries, it is not. But in the wealth management industry and certain other industries, deal volumes, deal valuations, everything about deals has only been increasing and growing despite what you would see as economic headwinds. So, history tells us that in addition to not getting frozen, we should not make blanket assumptions about the impact of any economic factor on any particular industry or type of deal or size of company or geographic area, whether it's by country or region or even state, right? That's another thing where things can be differently impacted. So what does that mean if you're a business owner, if you're an entrepreneur, if you're a deal maker? You want to evaluate for yourself, with whatever expert advice you want to take in or whatever, on what the particular impact of that particular economic challenge is on your particular industry, product, service, geography, etc. And then, look for the opportunities within that. And listen, I've said this, in episodes past, some of the biggest companies, I mean, there's evidence, some of the biggest companies has been born out of recessions, right? Some of the biggest opportunities come at the most challenging times. So, it's very interesting right now. I mean, there's a bit of a mixed bag, right? Jobs numbers are still pretty solid. Inflation rates, I mean, the unemployment rates have not gone up significantly. In fact, they've been pretty steady. Inflation is not pushing up significantly, although people are afraid that it might due to the tariffs and some other policies, but it hasn't happened yet. I've been interviewed on some stuff about PE money and, for example, the wealth management space. And there's some interesting data, not in the wealth management space specifically, because that space actually hasn't gone through significant cycles because, again, it wasn't that really adversely affected during the pandemic. And the PE money, has only come in force in the last 5-7 years or whatever. So you don't have another cycle with significant PE investment in wealth management space, where there was significant economic issues. But if you study PE, and there's been studies done on it, and I sort of brushed up on them recently because I was looking at the impact of challenging economic times on PE investment, because a couple of reports were asking, are looking into that in the wealth management space. So generally, and across the board in other spaces, the impact on PE investment usually, like even if the market went down, there was significant economic challenges, there's usually a lag, a year or so often before there's significant impact on PE investment. And why is that? That's because the PE firms, they have existing funds and capital that they've invested or maybe have dry powder and that they need to invest because they've raised the funds already. So usually they still have some powder right before, there's a lag right before they do it because they have money already that they've raised. Now, obviously, when they go to raise the next fund, especially if the economic conditions have adversely affected their ability to exit on their prior funds, then that's where it runs into trouble. But that could take 6 months or usually more, a year, 18 months, something like that to manifest, right? And then at that point, if they have to extend their existing funds and do capital calls, or it's harder to raise capital, that's when you see that impact. There's also interesting statistics because you would think sometimes that if there's a lag in how adverse economic factors impact a particular sector like PE, if it's lagging a year, let's say, being adversely impacted, that it might come back a year later, right? That it's just a later cycle. But the evidence shows actually that PE investment comes back more quickly than the overall economy and market. So it starts later and it comes back earlier. So that raises an interesting question because, and listen, we don't have crystal balls and we can't predict the economy, but we have to try to do it to some extent to back up our business decisions, right? So if you believe that, for example, if you're looking to raise PE money or you're invested, at a PE firm and you need some more money, you're thinking about going to the next bigger firm and having them take out, your prior PE firm, you may have some leeway here. And then, if you were thinking a couple of years out from that, well, then you have to look and say, okay, well, if we think things are going to go really bad, then we could be affected at that time. So maybe, do we need to accelerate that? Or you may say, oh, wait, I also understand, hopefully, if the PE thing performs as it was in the past, that it will come back earlier. But if we think we're going to have a 3 to 5 year downturn or, few year downturn, then it may be too late, right? So I'm not encouraging anybody to try to bet on or predict the market similar, to the stock market. But having this knowledge of what happens, for example, in challenging times with PE is a data point, right? And that helps those folks who care about that make some business decisions. So this analysis, some of you may know, there's a sort of parallel, not really, but a similar situation, somewhat similar that I sort of can get on a soapbox about, and it applies here a little bit too, which is like the one I get on a soapbox about sometimes are these prognosticators who or even just the regular financial media who come on every day and say, oh, the stock market's up today because of this, or it's down today because of this, right? And, my reaction is you have no idea, the stock market is so complex, unless there's been some black swan incident, some huge thing, right? That, obviously would have a huge impact. On a day-to-day basis, it's near impossible to say why the market has gone up and gone down in various times. And in fact, they contradict themselves a lot of times day to day, right? Today it went down because of tariffs, but there's still a threat of tariffs, and tomorrow it goes up and they pick something else that went up for. And it sort of can be the same way, with the deal market, where people just sort of make assumptions. Oh yeah, deals have dried up because of X, or they're going to go up because of Y. And in both situations, you have to understand the markets are so complex. There's so many factors moving. There are so many different segments. There's so many things happening behind the scenes. There's different ways that people are making decisions and money is moving. They're complex systems. So I guess the other thing would be to encourage you not to ever take an oversimplified view of it, because they are complex systems. And that, again, goes to encouraging everybody to try to really look much more specifically on the particular economic issue or uncertainty, on its impact, particularly on your business or sector, and where there might be opportunities from that. So don't panic, folks. Make those rational business decisions. Be aware of what's going on. Also, it's so easy, especially right now. It's a lot of these things have become so politicized. So on top of the fear or emotion that may come up about the economic impact, for some people on either side, there's significant emotion or triggering because it's become so political that also that can take you out of making rational business decisions. And I would encourage you to take that into account and be aware that that's not the place to make business decisions from, right? You can have judgment, you can hate a policy, but whether you hate it or you love it, the analysis of its impact on your business and the challenges and opportunities that come from it should not be affected about whether you hate it or love it, because it is what it is. And what it is the thing that you should be taking into account in your business. Now, it's a separate conversation if you want to consciously take a political stance or, take a principled stance, or you feel you're totally for or totally against something because it's in your integrity, and you choose to do that despite the impact on your business. And if you're a business owner without other shareholders and public shareholders and anything like that you have fiduciary duties to, I mean, it's your business. You can do whatever the heck you want. And if you want to make a decision, even if it may be against your economic interest, then that's your prerogative, right? But what I don't want to happen is that any of us are making irrational business decisions. See, that's a rational decision. You've chosen to have a principle, to hold by a principle and by your beliefs, even if it may economically affect your own business. And if you don't have anybody else to answer to, in terms of owners, you have fiduciary duties to, you can do that. But that's a very different analysis than having your emotional or triggering reaction to a particular policy or economic issue because it's been so politicized, clouds your judgment. So it's a time to keep a level head in these challenging times. And the best entrepreneurs are able to do that, sort of see the field clearly. Maybe you slow down a little bit, but not freeze, and make some good business decisions no matter what the environment is. And that's, over time, where you look at the companies and the entrepreneurs, the business owners who've been resilient and have lasted for a while compared to the ones that have run into, that did well when they were brilliant in a bull market, but ran into trouble once there was any, hiccups or challenges or issues in the economy. So that's my wisdom, to the extent you find it to be wisdom, but that's what I want to impart for you this week. This too shall pass, whatever it is. Stay resilient, stay clear-eyed, make good business decisions, and we will all be able to move forward and move on for this if we do that. So, folks, looking forward to being back with you on another solocast in 4 weeks, but we've got 3 great guests coming up between now and then. Take care. Thank you for joining me on this episode of DealQuest. where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com, and if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.